You're listening to this podcast, so I know you've got a curious mind. Here's a helpful fact you may not know yet. Drivers who switch and save with Progressive save over $900 on average. Pop over to Progressive.com, answer some questions, and you'll get a quick quote with discounts that are easy to come by. In fact, 99% of their auto customers earn at least one discount. Visit Progressive.com and see if you can enjoy a little cash back. Progressive Casualty Insurance Company and Affiliates. National average 12-month savings of $946 by new customers surveyed who saved with Progressive between June 2024 and May 2025. Potential savings will vary.
This episode is brought to you by Indeed. Stop waiting around for the perfect candidate. Instead, use Indeed sponsored jobs to find the right people with the right skills fast. It's a simple way to make sure your listing is the first candidates see. According to Indeed data, sponsored jobs have 4 times more applicants than non-sponsored jobs. So go build your dream team today with Indeed. Get a $75 sponsored job credit at Indeed.com/podcast. Terms and conditions apply.
Ladies and gentlemen, we have a big show, a real big shoe.
Live from Joe's mom's basement, it's the Stacking Benjamin Show. I'm Joe's mom's neighbor, Doug, and you say you want advice from the best financial people in all the land? We got you, Stacker, because today we welcome to the basement the man behind one of the nation's top financial firms, Ritholtz Wealth Management. Yeah, he's here, Barry Ritholtz. Barry shares lessons on how not to invest that you'll want to implement right now. Plus, you've had lots of feedback on our last few shows. We'll share your thoughts on losing a job, working remotely, movies, and more. And don't worry, I'm getting to it. Your trivia, of course, will be served just in time. And now, 2 guys who think diversification means having more than one streaming subscription. It's Joe and G.
That's not it. It's more than that. Hey, everybody. Welcome to the I was this many days old when I found out what real diversification was podcast, the Stacking Benjamin Show. I'm Joe Saul Seahigh, and across the card table from me, the guy who has Peacock, Paramount Plus, and Pluto. Just trying to think of all the
How
fringe.
rich am I? I've got Tubi and Plex.
I'm Pluto wealthy.
I don't know what any of those things are, so I'm going to say no. But if you haven't taken your iPhone, you guys can do this, and everybody at home can do this too right now.
Wow.
Do it with me.
This is a science experiment, kids.
This is a self-help. Take your iPhone, open it up, and from the top, swipe down and type in the word subscriptions, and then it pops up at the top, says subscriptions, and then you click on it, and it will tell you or show you all of the subscriptions that you have on your phone that you subscribe to. And so you can go through that and go, wait a second, why am I still subscribing to MyFitnessPal calorie counter? I haven't counted a calorie in 5 years. Unsubscribe, Or
hypothetically.
Another little hack is unsubscribe from all of them. You will still get to use them for the period of time for which you subscribed, and then just see if you notice that you don't have it anymore. And then you can resubscribe later. Sometimes they'll even send you a deal and go, if you resubscribe now, we'll send you a deal. But you look and you go, I don't really need to have this app anymore. I don't think I do. Just unsubscribe.
Doug, did he start giving advice 1 minute into the show?
I think we're done here.
You're talking about subscriptions, and
Who are we becoming?
I heard you talk about TV subscriptions, and I noticed this weekend that I still had a Paramount subscription, and I haven't watched Paramount in a couple of weeks because I was done with all the shows on Paramount that I wanted to watch. So.
I finally got rid of Peacock in January, and the Tour de France ended at the end of July. And that's the whole reason why I got it. And now, of course, I unsubscribed, and I'll resubscribe July 1st.
You're the guy that subscribes to Peacock for the Tour de France?
I'm the guy.
I saw the article about that.
It was incredible. A whole feature on the guy keeping Peacock Network alive. Oh, speaking of keeping alive, the guy keeping this show alive today, Barry Ritholtz is here, OG.
Oh, yeah, nice. Never heard of him.
We have no idea. And so everybody's on their best behavior. Mom is already upstairs making cookies. We got a great show today. Barry's going to talk about how not to invest. We've got your letters. It's going to be a humdinger, as Mom's friend Gertrude says.
A whiz bang?
A whiz bang. It's going to be lights out goodness. on today's podcast. But before we get started, we've got a couple sponsors that make sure we can keep on keeping on. You don't have to pay anything for this goodness. So let's hear from them. And then Barry Ritholtz, the man behind Ritholtz Wealth Management, joins us. You have read his blog. You have seen him on every financial channel, but not the best one, Mom's Basement. Barry Ritholtz is coming up next. You may not know that when we started Stacking Benjamins, it was a blog. And even then, just the startup cost, I remember thinking, is this the right thing? And what if I write things and nobody comes, right? Well, luckily, that didn't end up happening. But starting something new isn't just hard. It's terrifying. There's so much work. You're not sure whether it's going to work out. You're not sure if anybody's going to read it. And then we change it to a podcast. Is anybody actually going to listen, right? What if nobody wants all the stuff that we have? Well, had I used Shopify, it would have been even easier because with their expertise, their helpful tools, and their easy to use platform, that's something that would have made Stacking Benjamins more effective much, much more quickly. Shopify is the commerce platform behind millions of businesses around the world and 10% of all e-commerce in the U.S. Names you've heard of like Heinz and Mattel, Shopify, Gymshark, Aviator Nation, Allbirds, also all Shopify. Get started with your own design studio with hundreds of ready-to-use templates. Shopify helps you build a beautiful online store that matches your brand style. And best yet, Shopify is your commerce expert with world-class expertise in everything from managing inventory to international shipping to processing returns and beyond. And did I mention that iconic purple Shop Pay button? It's used by millions of businesses around the world. It's why Shopify has the best converting checkout on the planet. It also helps boost conversions, meaning less carts going abandoned and more sales for you. So you're stacking Benjamins much more quickly. Time to turn those what ifs into with Shopify today. Sign up for your $1 per month trial today at shopify.com/SB. Go to shopify.com/SB. That's shopify.com/SB. Dell PCs with Intel Inside are built for the moments you plan and the ones you don't. They're for those all-night study sessions, the moment you're working from a cafe and realize every outlet's taken, the times you're deep in your flow and can't be interrupted by an auto update. That's why Dell builds tech that adapts to you. Built with long-lasting batteries so you're not scrambling for an outlet, and built-in intelligence that makes updates around your schedule, not in the middle of it. Find technology built for the way you work at Dell.com/Dell PCs. Built for you.
We return you now to your regularly scheduled program.
You know, the really crazy thing is when you see some of the studies on financial literacy, it has a really finite half-life. You have to stay on top of people. They could be as educated as possible, and it fades. Eventually, it fades.
I think maybe the dopamine hit gets too strong, right?
There's some of that. It's funny because it's a process, not only learning. So first, you have to learn all these things that most people, unfortunately, never learn. Thank goodness for Kahneman and Tversky taught us so much about it. But then you have to recognize that so many of these things apply to you. And I had put a post up on the blog today about our blind spot bias bubble, that even as you go down the behavioral finance rabbit hole and learn all these mistakes we make, the assumption is it's that guy. It's not me. It's always that guy. It's funny. Somebody's name came up. We were talking about March Madness, and Batnick's 40th birthday is coming up. So I took him to a Knicks game last week. We got floor seats. The whole thing was crazy. And I started telling the story about Joe Bessiker of Emerald. And the story is kind of funny, just that I was a big Knicks fan during the Ewing, Oakley, Starks, Mason era. And Michael Jordan was the immovable force they never could get past. And I was convinced that the officiating was against the Knicks constantly. And then I went to this NIT game, and I don't give a crap about college basketball. I mean, I'll watch some March Madness, certainly the Final Four.
Yeah.
And if like a team has like a Michigan or a Tar Heels have a breakout year, I'll see a bunch of that. but he's a big alum, and all he saw was nothing but travel and foul and charging. And I'm watching the game with zero stake in it. I have no skin in the game, could care less. Joe, it's 2.5 steps. That's what's allowed. 3. Joe, his foot was clearly on the line. It's not even a little bit. It's like planted on the line. That's a charge. Joe, he was moving. He wasn't planted. And as the game went on, I had the sinking feeling in my stomach that, oh my God, my worldview is wholly delusional, at least when it comes to basketball. And then when I'm trying to remember, I don't think it was Kahneman's Noise, but he talks about this. It was like an early interview. It might have even been a pre-Thinking Fast and Slow interview where Kahneman, where I want to say Danny, but I don't feel like I should. Like Jason Zweig calls him Danny.
Yeah.
He talks about our own bias bubble and how even though I've spent my whole career studying this, Kahneman says, I have all the same biases and blind spots everybody else does. And it's horrifying when you hear that. I'm like, oh, I guess even worse than being an idiot is knowing what an idiot you are. It's really like, that's what I get for 20 years of studying this crap? Well, thanks. Thanks for nothing.
I don't know. Or is that better? I like that line. The more you know, the less you know. The more you know, and then you become more humble because you realize it's the you don't know that's going to get you, where you've got all these idiots that are out there that I see all over TikTok all the time, that are telling me all the truths of the universe that I need to know at 57 years old that apparently I didn't see before them.
There are some great, I love great quotes from really smart people, and the book is just sprinkled with them. But go all the way back to Socrates. The only thing I know is that I don't know anything. It sounds like it's an exaggeration or hyperbole, but it's a step towards recognizing the importance of modesty and humility. And, Wall Street is a fake it till you make it kind of place. Modesty is not the default setting by any stretch of the imagination, but it really helps you to be an investor. If you want to just avoid the avoidable errors, you have to be much less arrogant, much less cocky, and don't just assume you know everything. But that seems to be, especially newbies, and you could be a newbie for, 5 years, 10 years. I started in the business on a trading desk, so you kind of get thrown in the deep end of the pool, and whoever doesn't drown, congratulations, you're a trader. So there's a little bit of cockiness, but you better learn to identify really quickly. You know far less than you think you do. It's helpful not only to be aware of what you don't know, but to paraphrase the Twain quote, it's not what you know, it's what you think is so, but just isn't. And that's a big, that's what people really get destroyed.
Well, I was going to say, Barry, let's get started. But you know what? While we were talking, I just hit the start. So I think we're already in it. I think we're in it.
I don't think I cursed or said anything on inappropriate. So
no, not yet, but we'll try to get you going. We'll try.
Are we PG rated? Are we R rated? What can I get away with?
We are PG-13. So we'll swear from time to time, but we beep it out mostly because it's funnier to beep it out.
No, it definitely is amusing because it's not that hard to figure out what people say. Mother beep. It's like not that difficult. People aren't that silly.
I know. So I'm going to just tell everybody we faded up into it. I read this book back in the 90s called Trading Rules, which really is a boring book. And it's a
Who's
dude
the author?
I don't remember, but it was a guy at the Commodities Exchange in Chicago. And it's all of his rules. And here's a guy who's investing in stuff that 99.9% of your audience and my audience would never invest in a million years. And all he talks about is risk. All he talks about, the fact is, you got to give up the fact that you know what the price is going to be tomorrow. You even say this in your book, once we know that, once we realize nobody knows anything, right? Like we're going to be better off. But he's like, once I give that away and I realize what a little fish I am and how little I know, and people trade for all these reasons I can never fathom, no matter what it says on CNBC or Fox Business, I'm going to be better off. And it just blew me away how much this super professional seasoned trader was all about risk management.
I had the exact same experience you did, but with a different book. Do you remember Jack Schwager's first Market Wizards book? I want to say
we've had Jack on 3 times because I love that guy so much.
I was on a trading desk. My head trader handed me that book. My takeaway from that was so astonishing was it had nothing whatsoever to do with what you were trading itself. What you had to learn was how to manage yourself and how to manage your risk. And that's what was so astonishing to me, was it didn't make a difference what you were trading. Could be commodities, could be currency, could be stocks, bonds. It made no difference. Futures, it was all about having a process, having an approach, knowing when, on those rare occasions where you could let your rules be stretched a little bit, and managing your own behavior. That was eye-opening in the late 90s. I don't think a lot of people, at least in published format, were discussing that. And it's funny because the behavior you would witness on the desk versus what I was reading about is the difference between a so-so trader. And back then, in the pre-Reg FD era, it didn't even matter if you got good inside information. As long as you got it from a source that was plugged in, it could be bad inside information, legal inside information, speculative, rumor-driven inside information. But if you're early in the pyramid scheme, because that's what essentially these sort of Wall Street gossip was, as long as you're not late to the party, there was money to be made. And Reg FD really changed that. And the people who recognize, the whole risk scenario is completely different than it used to be, the people who recognize that did really well. And the people who failed to recognize that, we continue to see their excuse making going forward. Listen, I don't care if this manager or that manager has a bad quarter or a bad year. What I'm fascinated by is blaming the Fed's financial repression for my underperformance. Well, now that you know that the Fed is financially repressing the markets, shouldn't you be on the other side of the trade? I mean, you're not a grad student smoking clove cigarettes and drinking espresso. I used to joke about Cafe Reggio on McDougal Street across from NYU. If you're just going to go there and stroke your goatee, well, then you're a grad student. But if you're a fund manager, then once you figure out reality, why do you stay on the wrong side of the trade? Oh, you're emotionally involved in rationalizing what just happened, so you can't admit error and flip. Like, those sorts of things are really formative to somebody who just was intrigued not only by trading, but how come this guy's making money this week and this guy's getting killed? I'm pointing left and right. And then next week, the guy who's getting killed is just every trade is a winner. And the guy who is destroying, suddenly he can't trade his way out of a wet paper bag. And you start to recognize, it's their thought process. It's their, what they believe. It's their ability to come up with a process and stick with it. And that was really formative to me, seeing how people just made fundamental mistakes. Look, you don't have to be a robot, but it helps to not be a 2-year-old. It helps to not be, to infantilize every trade and fight the tape. And I saw a lot of that.
But in some ways, to have the curiosity of a young kid and to be willing to go with the next thing versus be so entrenched, in my opinion, I think is important. What I love about what you did in this project is taking stuff from outside finance and applying it to finance. And by the way, that's always where I seem to find my best inspiration, is when I look at these things and I apply it to my world, not stuff that's right on the, hitting right on the nail head. You talk about the music world and the Beatles. And it's amazing. I never knew just how much the U.S. was going, no, Barry. Like, no, there's no way we're going to accept the Beatles here.
Right. It started out with the Beatles record company in the UK was EMI. And I think in the US was Capitol, unless I inverted those.
Yeah, it was Capitol.
The EMI people, the UK people, are telling their American counterparts, this band is just tearing up the charts. You got to release this. It's like, no, we know American taste. This guitar music is over, they said in 1964. It's like you just, it's a flash in the pan. And at one point in time, the Beatles had the number 1 spot on the UK charts, the number 2, the number 3, the number 4, the number 5. How many times do you have to get hit over the head before you say, I don't understand this music, but something is going on here? Like, I give you a million examples from the modern day about things that, hey, that's not necessarily my forte, but there's a groundswell. Pay attention. You have to notice this if that's your profession. And so not only did they not want to release the Beatles singles here, Ed Sullivan turned the Beatles down once or twice. And then by coincidence, what used to be called London Airport is now Heathrow. He's coming back to New York through Heathrow, and the Beatles are coming home from, I want to say, Scandinavia or Sweden or somewhere, a tour, and there's 10,000 screaming teenage girls in the airport. Sullivan sees this, and when he gets back home, says, hey, I don't know what's going on over there, but get the Beatles here. It's a full-blown phenomena. To Capitol Records' credit, I should say, too good corporate opportunistic profit-seeking behavior. Before by the way, Ed Sullivan was one of the biggest shows on TV.
Sure.
He regularly broke acts. He regularly would cause giant sales booms. In anticipation of that booking, they kind of were forced to release a couple of singles, and they all went to number one, top 5, top 10, whatever, and sold 1 million copies like that. And like, oh, maybe this, maybe this Mercy Beat thing has got some legs. Maybe they'll still be here in 65, which is pretty hilarious. And then the reviews of the Ed Sullivan Show from professional music critics are, and admittedly, cherry-picked the worst. By the way, target-rich environment. There's thousands of terrible reviews. Bob Seawright is the first person who kind of wrote this up, and I did a bunch of Googling and picked a bunch of other stuff. But just like the Washington Post, the Daily News, the New York Times, it was amazing. People who should know better just didn't.
Well, I got the ones, Barry, right here that you wrote in your book. The Boston Globe, quote, don't let the Beatles bother you. If you don't think about them, they'll go away in a few more years. They'll probably be bald. The New York Times, the Beatles' vocal quality can be described as hoarsely incoherent with the minimal enunciation necessary to communicate the schematic text. It's awful.
The Washington Post somehow made it an inside the Beltway discussion about, once again, we got screwed in our trade with Europe. I thought that was pretty hilarious. But my favorite things are people who, look, you don't have to be a Beatles fan, but to write, hey, there's no melody or harmony here. It's like, no, what are you talking about? It's all melody and harmony. If you're going to not like them, well, then don't like them. But you can't just make crap up about it. It's obvious, and your criticism clearly 60-something years later, almost 60 years later, has not stood the test of time. It just goes to show you, the big lesson there, not only does no one know anything about what's going to happen in the future, to me, there's two giant takeaways from this. One is we all tend to find a little bit of a complacent comfort zone. And when that happens, it's very easy to not see the train coming down the tracks. It could be the dot-com implosion. It could be the financial crisis. It could be COVID, flash crash, whatever it is. Our sort of complacency, because we've found a comfortable level, is potentially problematic. For a lot of people, that meant missing the ETF revolution, missing the shift towards passive. There's like a lot of examples where people were just stubbornly comfortable in the past and failed to adapt. And I'm not even talking about selling the top and buying the bottom. I'm talking about, hey, is there a value to passive? Probably. Is there a value to SPACs? Not really. You have to be able to question things that either are new or are just bubbling up again. Like SPACs have been around for 30 years. They seem to come up every 10, 15 years. The last group of people have sort of moved on, and no one is around that remembers the last time they got burned by SPACs. But the other thing is, there's a great Paul Graham quote in the book, which is, when experts are wrong, it's because they're experts in the way the world used to be. It has to be that, because, whenever you got your doctorate, whenever you got your first couple of, it's always in the past. Whatever we know today is pretty much backwards looking and historical. And if things are changing, if the world is changing, well, then an expertise in the way the world used to be, it'll only get you so far. You have to be willing to adjust to changing conditions. And I don't mean day trading or turning your portfolio over. I mean philosophically understanding how to interact with the markets, the economy, and investing.
You talk about two characters in the book, Sam Zell, who, you look at Sam Zell back in 2015 and you think if Sam Zell's on CNBC, I'm going to watch and see what he has to say. Michael Burry, heck, they had a whole movie about Michael Burry in The Big Short. What's wrong following advice from people like Burry and Zell?
So there's a couple of concepts involved. One is epistemic trespass. When you're an expert in one space, that really shouldn't give you license to move to either an adjacent space or something wholly unrelated.
And this is Sam Zell specifically. I think you're talking about.
It's a little bit of both of them and Robert Kiyosaki as well.
Oh, yeah.
So how did Sam Zell become rich and famous? He is a phenomenally good distressed real estate investor. He got the nickname the grave dancer for when stuff run into trouble. He would be the only bid out there when everyone was panicking. Zell, solid contrarian instincts, would buy deeply distressed real estate and then hold it for decades at a time. I think some of his holdings were literally half a century, like crazy, crazy numbers. And then he just starts forecasting recessions. Sam never made a penny forecasting a recession, and he's like pretty consistently wrong. Although Zell was like a big famous name, and I wanted to start with something that was pretty obvious. The Burry thing is more nuanced because he's been forecasting a market crash kind of on the regular. He made close to $100 million on The Big Short. And he doesn't have to disclose any of this since he's a private individual, but some reports are that he pyramided that up to $1 billion. He's worth $1 billion now. I don't know if that's true, but I love the idea that not only was this guy a contrarian once, and most outlier call makers tend to be one-hit wonders and not repeat the skill. The way he trades distressed assets and the way he trades anticipation of things falling to the downside is really challenging because over long periods of time, the market tends to trend upwards. So you have to be not only precise in what you're betting against, but you also have to get the timing more or less right. In The Big Short, you find out that even 24 months is forever. And even when the bet starts going your way, then you're relying on the market actually marking things correctly. Like for 6 or 8 months of the collapse, none of these traded derivative products got marked down. So I understand this is a basket of mortgages. The average mortgage is, usually run a 2% default rate. It's 20%. How are these still the same price? I got more to sell for you if that's the case at this high price. He couldn't get a print that accurately reflected what was going on. It's so difficult to do. So I love the concept of him continuing to be, he's a phenomenal manager, but he's been forecasting market crashes, not quite as much as Robert Kiyosaki, who wrote Rich Dad, Poor Dad, or as my colleague Ben Carlson says, Rich Dad, Poor Reader. Here's a guy who literally wrote the best-selling finance book of all time. You think Morgan Housel's book at 7 million copies is a blockbuster? That's not even a quarter of what Rich Dad, Poor Dad. That sold like 32 or 33 million copies. It's like a crazy number. Some guy on Twitter tracks all of Kiyosaki's tweets. And every year since the financial crisis, he's been forecasting a crash. One of my favorite forecasts of his was in 2018. Sell U.S. real estate. Big crash coming. You don't want to own any residential real estate in the U.S. I don't think there was a better time in our lifetime to be a buyer of U.S. real estate than 2018. And so when you see these people who have authority and some recognition and some level of success, the danger is that we, the home viewer, very much tend to believe people who are confident, who are really specific. The old joke is, why do economists use 2 decimal places? It's to prove they have a sense of humor. But when we see people forecast stocks, 47,653, we all know it's a throw of a dart. The viewer loves that. And anyone who's gotten an outlier call correct, not only are they more likely to make more outlier calls, and not only are they more likely to be incorrect, but the home viewer or reader loves those people and tends to believe what they say.
It's so absolutely frustrating. I often, whenever I see Kiyosaki today, I just wonder how this guy keeps a huge audience, because he's been wrong on so many calls in a row. Like, you can be wrong 50,000 times in a row, and yet still you've got this massive amount of people that want to have you come speak, have you come. I don't understand it.
There's a fund manager that consistently bears since the financial crisis. and started out with, I don't know, 8, 10, 12 billion dollars down to like $1 billion. And one of my, might have been Batnick said, he was down to like $950 million. And someone said, how long do you think this bull market's going to last? And Michael's answer was, still another $950 million to go. And there's some truth to that. You know, the guys who are like perma bears, when they finally throw in the towel, when there's nobody left to buy, when all the shorts are covered, tends to be capitulation means surrender. When everybody in a downturn just gives it up and pukes up stock, that's how bottoms are made. And you can make the claim that when you run out of bears, when you run out of sellers, that's how tops are made.
I remember back in the early 2000s, back when I was a financial planner a long, long time ago, Harry Dent Jr. Remember Harry Dent Jr.?
Sure. Population drives markets.
Yes.
Except it doesn't.
Well, that made, and by the way, when I first heard Harry Dent Jr., it blew me away, Barry, because I was like, this guy knows he's exactly the prototypical what you're talking about. And I remember reading the Roaring 2000s and going, oh my goodness. And so it kind of helped my cynicism later on when I noticed this dude was selling annuities and where everything's going to roar. If everything's going to roar, why do I need all this downside protection with the annuity market? You similarly loved, quote, a book called Dow 36,000, which I think, Barry, these were out about the same time, these two books.
The timing was so perfect. Dow 36,000, I want to say, came out the fall of 1999, which meant you had a quarter or two from publication date to get out of the market if that's how you invest. And what was so fascinating to me, there were two big takeaways from that. One, these guys were political analysts, and they've sort of evolved into, in fact, one of the two authors works in this administration. But the first thing is the recency effect that, wait, you're telling me after 1,000% 18-year bull market, now you're pounding the table to get bullish? And your forecast is simply just taking the previous 7 years, which have been unusually robust and strong, and you're just tacking that on to the end of an 18-year bull market. Like, intuitively, that immediately was a red flag. But the other thing was their fundamental thesis, if anybody who bothered to fight their way through the book, which was pretty poorly conceived and written, was their fundamental premise was sort of, it's not that valuations don't matter, but valuations for stocks are so much cheaper than bonds that you have to own stocks. And I'm like, I didn't understand their methods, their models. None of it made any sense other than we want to have an outrageous discussion that would attract attention. It was that book title was kind of clickbaity, and it worked for about 6 months. You know, they did CNBC, they did Bloomberg, they did Fox, they did all the television shows, you know, the morning shows that they, like, a lot of people spoke to them. And I'm trying to remember which company. You're kind of my era. In March 2000, was it Dell that pre-announced? It was one of the companies that had said Y2K pulled forward all of this hardware buying in the fourth quarter of 1999. Maybe it was Intel, could have been Dell. It was a company like that. And that was the first crack, and that was just the beginning of the end. And it very rapidly unwound. And as you watched it fall apart, you know, the muscle memory of being rewarded every time you bought the dip was still fresh and still strong. And so a lot of people a lot of traders and investors, both amateur and professional, got really slapped around in 2000, 2001. By the time 02 rolled around, like October 02, it looked like the selling was done. You started to find stocks that were trading for cash on hand or less than cash on hand.
Right, yeah.
And that's a good sign that, all right, you know, these things don't go on forever. And to be fair, you didn't get out of that trading range till 2013. You know, a lot of people like to mark March 09 as the start of this bull market, but it really isn't. That's the equivalent of the 73, 74 bear market, the crash. That was about the same 56% and change as 08, 09. You don't start the new bull until you breach the previous highs. You don't just start it from the very low, because, hey, from 66 to 82, we saw a lot of false starts and a lot of crashes. And the same thing from 2000 to 2013. So a lot of like, oh, this looks good. And then, you know, the rug gets pulled out. So you need to be a little bit of a market historian if you want to be. Look, in the book, I talk about the advantages of dollar cost averaging and buy and hold and broad passive ownership. Hey, if you want to decorate the Christmas tree with some active ETFs or strategies, a little garland, a few ornaments is fine, but the bulk of what you're doing should be that low cost passive. If you want to do anything beyond that, you really have to be a market historian and understand the broad history of what's come before. And even knowing it doesn't guarantee you're going to get it right. It just gives you some insight into here's how the humans dealt with this last time. Now let's see what they do going forward.
Well, and as a little bit of a market historian, I really felt this. You didn't write this explicitly, Barry, which is why I want to ask you about it. This is a little bit of a cautionary tale about loading up on the Magnificent Seven right now, I would think.
Yeah, and it's funny because the book actually it looks longer than it is. There's a lot of 1 and 2 page chapters.
It is very, very short, concise chapters. Yeah.
But there's a lot of white space. So the 400 pages is really much less than that because forget all the footnotes at the end, but like there are a lot of 1.5, 2.5 pages throughout. But some of the examples that we use, when you think about the telephone company a century ago, there were a handful, or especially Ma Bell, but there were a handful of telephone companies and manufacturers. You didn't have to invest in any of those companies so much as recognize that the rest of corporate America that was at least service-oriented, this was going to be a big productivity booster and profit boost. The same thing in the 1990s with the dot-coms. It's sort of funny, and you're old enough to remember when we referred to these companies as internet companies. What publicly traded company today doesn't use email, doesn't have a website, doesn't use technology in a way? But that's not how we talked about internet companies. And I have jokingly referred to, if you're looking at AI and the Magnificent Seven, the value is not going to be necessarily in us picking one or two of those companies, be it NVIDIA or Microsoft or whoever. The value is going to be the next 493 companies, all of which will become more efficient, more productive, more profitable. That, and I don't want to be Pollyannish about this, but history has told us again and again, whether it's telegram or phone or the automobile or the computer or the internet, now AI, there's a process that takes a decade plus before everybody figures out how are we going to use these newfangled website thingies. And then, here's what we can do. I assume AI, maybe it won't take a decade, but it'll take a couple of years. And eventually everybody just becomes that much better. That's not because I have any special insight into AI. Trust me, I don't. But when you look at every new technological breakthrough and how it's been deployed, even mainframe computers, like for the longest time, it was giant insurance companies that were doing these big number crunching on expected payouts for life expectancy and annuities and insurance plans and all these different things required a huge ability to crunch numbers. Eventually that made its way downstream until eventually, hey, we just have a database. We're using Excel. That's all we really, or Oracle or SQL or whatever it is. But the technology eventually makes its way into the whole system and everybody does that much better.
Yeah, we keep wondering. I mean, my whole career and your whole career, you keep looking at the productivity numbers and go, how can we get more productive? There's no way. There's no way. Humans are stretched. We can't. And then now you got the AI wave. And I just look at my productivity using AI today versus just 2 years ago, Barry. It's, and like you, I'm not an expert in it at all, but man, it's part of our system today to plug in.
I've been having this ongoing debate with my economist friends because I just look at what we do in the office. We always talk about productivity and I say, I know you think there's no productivity gains, but I can just see the evolution in our firm. How much time, like I have a vivid recollection 2 jobs ago, printing out quarterly statements for clients, performance statements, and having to have everybody's portfolio, which all were at the core similar, but all these different variations, and painstakingly making sure that the right cover letter and the right performance update went into the right envelope and got the right sticker. Stop and think about like how manual that was. And we had a few hundred clients. You never could have scaled up to a few thousand clients. And then you think about just the sort of thing we can do today with tax loss harvesting and direct indexing and just the ability to move money securely, easily, quickly. I rebuilt a car in South America, and I was using an app called Remitly, and there's another app called World Remit to move money down there. That used to be like a painful process of going to the bank with 2 forms of ID and wiring $10,000. Why are you sending money to Bogota, Colombia? Well, I like cocaine and I'm having them ship up like a couple of pounds. Me and one of my colleagues at work saw a truck that was rebuilt in Colombia and started doing some research and discovered that for whatever reason, Colombia, South America became the Toyota FJ capital of the world. They have tons of them and they rebuild them all. And if you want to rebuild one in the US, it's, to do a nice job is a full paint job, the whole thing, $40,000, $50,000, $60,000. It's half the price down there. Yeah, it's a little longer. You have to ship it up to the States for $1,000 back then, or $1,200. The original hesitation to do it was moving money was a big pain in the butt internationally. And wait, I'm a SEC registered. I don't want to have to explain why am I sending $10,000 from my personal checking account to Colombia? But these apps now, you create a record. It's like, no, it's going to, so-and-so's garage. We're rebuilding a truck. Like it felt like, I could do this and not go to jail, which is always a bonus. So the technology just, and it's funny because I talk in the book about Paul Volcker talking about there's been no financial innovation since the ATM. And maybe when he said that, I don't know, 15, 20 years ago, maybe that was true. But today, it 100% isn't true. Everything is cheaper, faster, better than it ever was before financially. And again, this comes back to, hey, when you start to observe these big shifts, these big changes, I'm not telling you liquidate your portfolio or go all in on AI, but pay attention to what's happening and find ways to use these new tools to your best advantage. I just think about what we used to do with the blogs and the podcasts. My quarterly call to clients was a painful ordeal 4 times a year because everything had to be done manually and everything had to been it was one take. There were no edits. So now the technology to put that together is just, it's so easy. And it just, oh my God, you could be, this is why I'm stunned. Now, the best pushback I've gotten from an economist was, you're in a service industry, one that happened to be particularly unproductive. So there was a lot of headspace. And, it's much harder to make those gains in manufacturing. Okay, maybe. But, you got to be aware of what's going on in the world.
The next breakthrough. Like, we just don't know what's coming. By the way, the one place we need innovation, I know that Sheila Bair was one of the people that blurbed your book.
Yep.
You and Sheila and I got to get together and figure out, why is the ACH the same damn thing it was in 1988? like why the heck?
It's all the legacy technology that underlies this. In fact, I'm not big, as you can tell from the book, on making forecasts. When I'm always looking to see what is going to be the disruptive technology that either puts myself out of business or any of the technology partners and or financial players that we all interact with. And, for a long time, people thought the robo-advisors were going to put people out of business. We were pretty sanguine about that early on because if you work with enough, so we have no minimum, we'll take accounts no matter what size, but we have some pretty substantial households that we work with. Wealthy people aren't looking to get cheap or free advice. They want the best surgeon, the best lawyer, the best accountant, and hopefully the best financial advisor / wealth manager. So we didn't
feel like they also want to have a conversation from time to time too, Barry.
Especially when the hitting the fan and everybody's freaking out. They want someone to talk them off the ledge. When I look around, and we were just talking about those legacy systems, when I look around at the custodians, I'm shocked that nobody has come up with a way to disrupt them, other than it's not exactly a high margin business. And there's a lot of heavy lifting and a lot of risk. And I think that's what's prevented technology from challenging them. But they're like, when I look around, it's like, gee, that's a tough business, especially now that trading is free. I don't know if that's a business I would want to be in.
Yeah, I don't think I'd want anything when it's a race to zero and you've achieved it. Like that's tough. The book is available tomorrow, everybody. It's called How Not to Invest. And if you thought this was a fun conversation with Barry, wait till you read it, because I found myself flipping chapter after chapter and going, oh man, that's good. And also laughing a fair amount of the time. Barry, thanks for mentoring us today.
Well, thank you so much for the kind words. That is exactly the reaction I was hoping for. And when you're in the thick of it, you just never know, if you're hitting the mark. I will say, unlike Bailout Nation, which was kind of a slog to write, aside from the fact that every 3 months another company would blow up and I'd have to rewrite that whole section of the book, this book was a joy to write. It was fun revisiting some ideas and kind of seeing how they've held up and expanding on them, and just looking outside of typical Wall Street writing to find ways to teach people, hey, if only you don't make these mistakes, you'll be great. You'll be fine.
Hey there, Stackers. I'm Joe's mom's neighbor, Doug, and today is National Create Your Own Holiday Day. Wait, I can create whatever holiday I want? Really? Oh, wow. Well, the honor is all mine. Where do I start? Oh, I know. We're going to call today Bow Chicka Wow Wow Day, because if it's your birthday, happy birthday. And here's why it's Bow Chicka Wow Wow Day. If you were born today, or heck, even this week, there's a good chance your parents were getting busy making you on what holiday. I'll be back right after I go bring out the sparklers for today's big reveal. You're going to love the answer.
You're listening to this podcast, so I know you've got a curious mind. Here's a helpful fact you may not know yet. Drivers who switch and save with Progressive save over $900 on average. Pop over to Progressive.com, answer some questions, and you'll get a quick quote with discounts that are easy to come by. In fact, 99% of their auto customers earn at least one discount. Visit Progressive.com and see if you can enjoy a little cash back. Progressive Casualty Insurance Company and Affiliates. National average 12-month savings of $946 by new customers surveyed who saved with Progressive between June 2024 and May 2025. Potential savings will vary.
You didn't start a business just to keep the lights on. You're here to sell more today than yesterday. You're here to win. Lucky for you, Shopify built the best converting checkout on the planet. Like the just one tapping, ridiculously fast acting, sky-high sales stacking, champion of checkouts. That's the good stuff right there. So if your business is in it to win it, win with Shopify. Start your free trial today at shopify.com/win.
Did you know Fast Growing Trees is America's largest and most trusted online nursery with thousands of trees and plants and over 2 million happy customers? Whether you're planting fruit trees, adding privacy, brightening things up with flowers, or bringing in houseplants, Fast Growing Trees has it all. Even better, they can help you find options that are right for your climate, your space, and lifestyle. Click Order Grow. Every plant arrives healthy with the Alive and Thrive guarantee straight to your door. So if you're ready to get planting, this is the moment. Right now, they have great deals on spring planting essentials, up to half off on select plants. And listeners to our show get 20% off their first purchase when using the code WWO at checkout. That's an additional 20% off. Better plants and better growing at fastgrowingtrees.com using the code WWO at checkout. Fastgrowingtrees.com, code WWO. Now's the perfect time to plant. Let's grow together. Use WWO to save today. Offer is valid for a limited time. Terms and conditions apply. Go to growingfasttrees.com for details.
Hey there, Stackers. I'm the guy bringing to life a new holiday, and also the guy Joe's mom won't let carry fireworks into the basement to celebrate. Joe's mom's neighbor, Doug. Shouldn't we be able to celebrate Bow Chicka Wow Wow Day however we want? According to Joe's mom, the answer is, quote, makes air quote sounds. What the hell are air quote sounds? Okay, I'll try it. Not if you want to keep using my basement, because she thinks fireworks will, quote, maybe send the house up in flames. What a worrier. Sure, there was that one time last year when we singed OG's eyebrows, but that guy loved every minute of it. You know, once we got the cat unstuck from him. It's a long story. But on today's Reason for Celebration, Bow Chicka Wow Wow Day. If you are celebrating your birthday right now, which day did your parents probably have a great time celebrating? It turns out that your parents were making fireworks on Independence Day, of course. It was also the day when you began seeking your own independence 9 months later. Happy birthday, Stackers. I'm going back to celebrate more, and you're headed back to Joe and OG.
Making some fireworks, OG. We had some fireworks down here in the basement with Barry Ritholtz here, but some people go putting the math together for the first time. Wait a minute. Hold on. Big holiday, tons of fun, barbecue, and some fireworks.
Next topic.
Let's head into your letters because, OG, we've had some great letters. Doug, you've got the mailbag.
Yeah.
Let's talk about some of these letters. I know that Gavin had some thoughts for us. Thanks, by the way, for the note, Gavin, about our show on, when the job goes bye-bye. That was episode 1646, when the job crumbles, preparing for life surprises. And this is the surprise that happens to some of us when we go to meet with our boss, Doug, and HR happens to be in the room as well.
Yep. Gavin sent us a great note saying, having been let go in recent months, I can state for a fact that many top performers, mid performers, and bottom performers were let go in a downsizing event where we were names and numbers on a spreadsheet, and it had zero to do with the rating we had or our value to the company. This is especially true at very large, publicly traded companies where I have seen it multiple times in my 29-year career. Luckily, this is the first time I was impacted. Thanks for the great show. As always, cheers. And Doug is amazing, Gavin.
might have put a word or two in there that Gavin may or may not have said.
Pretty much read it verbatim, I think.
But the gist of this, OG, you don't know. I mean, when I got fired, I had just received the best performance evaluation I'd gotten at that company. And 2 weeks later, and I knew, by the way, my boss did not like me, and I knew my boss was looking for a reason to fire me. I told my dad a couple weeks before. This was at a smaller place, so I knew that
Somebody didn't like you? That's so weird.
I knew that I was already in the hot seat, and then I get this wonderful evaluation, and then bam, it's gone. So it can come at us out of the blue.
Anytime. Obviously, if you're a top performer, you feel like you're safer than bottom performers. But like Gavin said, at the end of the day, sometimes the reaper comes for you regardless, and you're just a number on a spreadsheet with a cost and ongoing expenses to keep. And they just, with a sledgehammer, just chop you out of there. That doesn't make any sense.
What?
With a big, giant butcher knife, chop you out of there. I don't know.
There it is. With a big sledgehammer, just chop you out. I don't know.
Business, it's not personal.
They cut down the tree with a big old hammer.
How does this guy's ever used a hammer before? We get pushback often, Gavin, to your point, we get pushback often on why do I need an emergency fund? Why do I need this money sitting in a bank account doing nothing? And yet it's that bank account that you're so happy that you have. I just happened to a family member just recently who was super happy. He's like, I think the number, OG, was $58,000 to live on. $58,000. And knowing that you have $58,000 sitting in a safe place is a great place
think about
to
the
be.
government employees right now. There's a bunch of stress going on. And if you're a federal or, some states are going through it as well, employee and you think, oh, I work at such and such a place, or I work for the U.S. Treasury. I'm not going anywhere. I'm an IRS agent. It's like, oh, well, maybe you are. And
not the job for life you thought it was.
Yeah, it's not going to make it feel any better, if you get let go, but it's going to give you the opportunity to just go just a half a step slower on the next decision, whatever it is. You still have to hustle. You still got to do all that stuff necessary to find the next thing. But if you've got a little extra cash or you've got your emergency fund in the right place, you don't have to be as worried.
We talked about 10 of Barry's maxims around investing on Monday. And I think, OG, this kind of applies because the people that I worry about are not the people that are working for shaky organizations, to your point, where they think they see it coming. It is the people 100% to your point. They're like, no, I got a great job. I got a great boss. I love it. And as a guy who's had a great boss who was then replaced with the worst boss I've ever had,
Apologies.
You're one job change a notch above you from going from your favorite job to a horror story. And that could happen next week.
Yeah, absolutely.
Horrible stuff. Yeah. Great points there, Gavin. Thanks for that one. What else we got in the mailbag, Doug?
We got another note from Lance who says or asks, could you discuss the pros and cons of Buffy ETFs? Is it possible to create your own?
I think that's buffer ETFs.
Oh, sometimes I just read so fast.
Buffy ETF is after that older show, Buffy the Vampire Slayer. ETFs
Yeah, that's
made
what I
after
thought
that.
he would. I mean, that's what I'd want to create.
Absolutely.
Anyway, he wants to know, Lance wants to know, is it possible to create your own and avoid high fees? Thanks. And Doug is amazing. He said that too at the end.
This is also, OG, after some of the investing shows that we've been talking about lately and some of Diversification Matters. But what exactly is a buffer ETF? What's he even talking about?
I have no idea. I had to look it up. I figured I would guess, and I guessed right. But it's basically a scam where companies try to get you to give them more money in exchange for your results. And that's that.
Wait, is a buffer ETF then buffer ETF like a
basically what it does is it combines option trading with a ETF in this case, and the idea being that with some option trades you can limit your downside.
Oh, this goes back to our crypto, our zero market neutral crypto fund garbage that we talked about a few episodes ago.
Well, or what Barry talked about in his book, there's no such thing as the free lunch, and everything has a cost associated with it. There is no such thing as 20% risk-free, just like there's no such thing as inexpensive risk-adjusted. Every time you take money to prevent upside, you have to be, or prevent downside, rather, you have to be preventing upside. That's just how it works. So I looked this up. I looked up an iShares product. iShares is a good company, BlackRock. Basically, it's a year product. It's an ETF that you buy, and they say, okay, we're going to give you 10% on the S&P. And you go, great, that sounds awesome. Until they start using these option trades to account for potential downside. As I look at it today, they have 108 days left. This goes until the end of June, I guess. And the maximum upside of this fund is 6% right now. Well, the S&P over the last 1 year is 9.5%. So if the S&P was flat for the next 3 months, obviously, may or may not be, it's a 3% delta. You're going to get 6 versus 9. And I get that the whole idea is like, well, yeah, but I didn't lose a whole bunch of money. How many times of giving up 2, 3, 4% a year do you have to get before you make up for the one time of, a minus 20? And the minus 20 only sticks with you if you sell it. Like, that's the crazy thing. Again, this all just boils down to, if you're trying to match up your timeframes of your goals with the timeframes of your money, none of this ever has to be a concern to you. Where it gets to be a concern is where you go, oh my gosh, I need to invest really super aggressively, or I need a high return. You don't even think about investing aggressively. You just go, I want a high return. Then it goes down by 30 or 40%. You go, oh, the market's rigged. I knew that was a scam, da-da-da-da-da. It's like, well, no, that's just part of the deal. The stock market 1 year in 7 is going to go down a third. Just look at history. It's all there. It's like when people go like, oh, tech stocks only go up. It's like, wait, no, we've had this book before. I've read it. It was in 2000. We were all there, the three of us. If you weren't there in 2000, ask somebody who was. The famous Mark Twain quote, history doesn't repeat itself, but it often rhymes. This is the same thing over and over and over again. Anytime. And this is when you get to market volatility, go watch your favorite news channel, Fox, MSNBC, either one, doesn't matter. All the ads during the day are for gold.
CNBC, not MSNBC.
No, MSNBC or CNBC, whatever, doesn't matter.
You talking about your favorite political channel?
Yeah, I'm just saying news. Yeah, like wherever
Just
you
whatever.
get your news.
Gotcha. Okay.
News channel, money channel, doesn't matter. I don't really care.
Yep.
Some sort of cable news network. How's that?
Okay,
CNN,
sure,
whatever
yeah.
the pleasure is.
Okay.
You're going to see 2 ads. The one ad is going to be William Devane going, my money's in gold. Or you're going to see the commercial about protect your downside with blah, blah, blah annuity. All the smart people are doing blah, blah, blah annuity. And that's all that's on people's minds right now is, oh my God, the S&P is down 10%. Oh my God, what do we do? Guys, look, the intra-year peak to valley average is 14. If minus 10 gets you all squirrely, you're doing it wrong. It doesn't move anything until minus 15. You're not even average until minus 15 in the year. So wake me up when it's minus 15 and we can say, oh, hey, guess what? Today we're average. It's an average year. JP Morgan puts together this great report every quarter, and they update some things monthly called the Guide to the Markets. And you can just Google this, called JP Morgan Guide to the Markets, and you can download the slides. They don't add any commentary to it generally. It's just data. And I find this data to be very helpful to really provide some context for where we happen to be in this seasonality or cycle or whatever you want to call it. I don't think it's predictive in any nature, and I don't think it's a necessarily decision-making tool, right? It's not like, oh, PEs are really high, therefore we should do this. But I think it provides context and color commentary for what you're seeing and experiencing. Is it more likely to have a lower return year when you've had 3 out of the last 4 years be 20%? Yeah, that kind of makes sense to me, right? If the average of the S&P is 10 over the last freaking 100 years and you bang out two or three plus 20s in a row, well, what does that mean? Does it mean that historically the average from now on is going to be 20 for the next 100 years? Or does it mean maybe, just maybe, that we have to get a 0 in there to get the 20 and a 0 to equal 10? Or it was a 30, do we have to get a minus 5? Like this just, I don't know. I got to stop. Just breathe through.
Wow. His face got redder and redder and redder throughout that entire thing.
I wasn't going to stop him. Were you going to stop him?
No way. I was terrified.
Breathe. I need that. What's that? I think I'm going to get out hold on. Go back to your subscriptions. Calm app.
Calm app, yeah.
Subscribe.
It's a perfect day for Lance's question with Barry here. How not to invest. Don't invest in things like a buffer ETF.
Well, I mean, he said, can I do this on my own? And the answer is, yeah, you can. You can just go buy puts or, sell calls. Every side of that transaction, there's a good thing and a not so good thing. I mean, just you go, well, if I bought a put, which means I've got the right but not the obligation to sell at today's price in the future, that could be beneficial for you, right? If the market goes down 20% and you've got a piece of paper that says, well, hold on a second. It says here, I get to sell as of March 15th. I'd like to use this. They go, oh, all right. Then you're good. But how many times do you not win that? How many times do you pay that for that piece of paper and it expires worthless? An option contract has a $0 intrinsic value. There's no terminal value. There is no, at the end of the day, it's worth 0. It's just a binary gamble. You can look and say, well, but I think the market, cool. Make your bets then. But know that when you do that, you are impacting your results. You're impacting your returns on both sides. Because if you spend the money and you don't get to exercise that option, what did you do? You used your capital. It went to 0. It was like buying a stock that went to 0. Like it's just, whatever.
Here's the problem though, OG, which is kind of goes back to our show on Monday, which is if you're trying to control volatility on something that you don't need for 15 years, my question is why?
Yeah.
Why? Because all you're doing every time you buy an option, the option has an intrinsic cost. And in some cases, I like the cost because I like the insurance policy. If I know that I'm in a position too long that I probably shouldn't be in, but I want to see if I can wring it out a little more, I might buy an option and fully accepting the fact that I got to pay X amount of money as an insurance policy to ensure the fact that this stupidity that I'm engaging in is not going to go against me, right? That I can go ahead and do something which is not technically what I maybe should be doing. But if I get a strong feeling that this is going to continue to go the way that I want, I can buy an insurance policy against that. But I also accept the fact that that's going to cost me, that it's going to bite into my return.
Big time.
Yeah.
Sure does. And the less risk you're willing to take, the more that cost is, just like any insurance.
Yeah, Lance, thanks a ton for that. No,
thanks for winding OG up, Lance.
That was our whole goal with that one, Lance. So mission accomplished, buddy. Who else we got?
Yeah, we got another really good one from Bob, Stacker Bob. He says, regarding SB 1653, which if I'm not mistaken was first week of March of this year of 2025.
Yeah, this was our one of our rewind episodes actually. And I think what Bob, by the way, might have missed this, that this episode was from when we were just coming out of COVID. And so there was a big discussion about work from anywhere. Because if you remember, Doug, everybody was working from home. Everybody was still working from wherever the heck that they were. And the beginning of his message, which I didn't include here, was about how, man, you guys really talked a lot about working from anywhere. Well, Bob, and I apologize because I did not put this at the top of the episode enough. That greatest hits episode, everybody was working from home. Anyway, but he does make some fantastic points.
Let me go on here because he does make some good points. Bob says, while I support remote work, this episode missed the mark for workers who cannot work from home. It highlighted a stark disparity within organizations, those who work remotely versus those who must be physically present, which can be both divisive and unfair. Consider professions like medical workers, restaurant staff, law enforcement officers, and many others who face additional challenges and expenses such as long commutes. And then he actually sent us a link. He referenced a 2024 piece from the U.S. careerinstitute.edu, a piece that came out after this episode originally aired. But anyway, it was a good article. The article mentioned that remote workers in the same metro area reportedly receive a $12,000 raise over their in-office counterparts, a figure that doesn't even factor in the true cost of commuting. Yes, issues like the blurred boundaries of work-life balance for remote workers and increased productivity are real, but the use of work phones suggests that the difference between remote work and office work may be less significant than assumed. After all, a call during a 72-minute daily commute is still work-related. The tone of SB 1653 felt dismissive of those who must report to an office.
And that, by the way, is because it was during COVID, Bob. It was because,
it wasn't an option.
Don't get me wrong. There were people like my spouse who were going into the hospital every day that did have to work from there. But I don't think we were dismissing people out of hand as much as we were acknowledging the times. But anyway, continue because I like where he's going.
But he still brings up some good points. So it's worth going through it. And that's why I wanted to bring it up today. He says, could we explore solutions to address this disparity? For instance, should in-office workers receive higher compensation to offset additional costs, or should remote work come with adjusted pay reflecting its conveniences? Throughout the pandemic, I embraced a hybrid model and experienced firsthand the cultural and organizational benefits of being in the office. The collective effort, everyone coming together despite individual hardships, creates a sense of unity and shared responsibility. This is not an anti-remote work stance, Bob says. Rather, it is a call for fairness. Without addressing these discrepancies, either by equalizing conditions or compensating differences, the concerns highlighted in the episode may increasingly resonate with a growing number of workers.
Well, and I think he makes an interesting point, OG, about people that, the whole cost of your job. What does your job really cost? What does it cost you to do the job? And when you're looking at salary A versus salary B, do I get the convenience of working from home versus the commuting cost and all the extra costs that Bob mentions here of going into the office? I need to compare those. In terms of fairness, I think fairness, though, OG, is up to the marketplace. If there's a boss that will pay you more to come into the office, what does the boss get for that? Hopefully the boss gets loyalty, gets people that stay at the job for more than 4.x years, which is the average amount of time somebody stays in a job. So hopefully that pays that you have an enlightened boss that does it. And I think looking for that job is a noble thing. But I think the question, and this is capitalism, right? If Barry here today is a great thing about this, with markets going up and down, job markets change. So it's up to employers. Do you want to reward that? And if you don't, is it going to be harder for you to find a worker? I don't know. That's all marketplace related.
I don't know what there is to add commentary here. I think everything works itself out how it's supposed to work itself out. If you are underpaying for a service or for a position, regardless of whether or not it's in the office or not in the office, eventually you'll figure that out because the market forces will align against you. And if you're overpaying, you'll figure that out too, because you'll have lots of applicants. You figure that out too. So I don't think you can mandate or regulate, if you work from home, you get an extra, you get a work from home fee. Like what? Could you imagine? Doug would be incredulous. He'd be like, what do you mean I owe you guys money to work here? Like, well, it's a work from home fee, Doug.
Mom keeps trying to do that to us. A basement related tax.
But I do think that there's a little bit of a moral obligation to, there was this hack. I don't know if it's still as prevalent, but there's this thing where people would work two jobs. Have you seen this? Like you
Yes.
work from home, so you can just work for two companies. Like they don't know, and you're not going to volunteer the info. So
We did the story, OG, remember before COVID, guys, we did that story about the guy that got caught. He made, I think, $80,000 a year working this job. He paid somebody else in India to do the job for him, $40,000. He ended up doing nothing by outsourcing his own job to somebody else.
I think companies now have best efforts clauses in their employment agreements and stuff. Like your full-time focus needs to be on this organization. I don't know how you police that, but I think morally it'd be a little jacked up to be working for one company and then also working for, a competitor or something. I don't think that really flies, but I don't know. I mean, you can work at Dick's Sporting Goods and go work at McDonald's too. Why can't you have two part-time jobs? And what's the difference by having two full-time jobs? Maybe. I don't know.
It's interesting to see too, as that Greatest Hits episode was coming out of the pandemic. And around that time, Doug, we had a discussion about work from home, and you were talking about how work from home is better. And a lot of our stackers 100% agreed with you, disagreed with me, that being in the office, I thought was where we were headed. But it does appear, for better or worse, that is where we are headed. You look at the statistics of the number of people that are in the office now versus in the office a year ago, and the number of companies saying return to the office. Heck, that was part of the, some of this new federal government stuff. Nope, you're not working from home anymore. You are coming in, which is funny when you look at Washington, D.C. having gotten rid of a lot of parking spaces, created some issues because we thought it was forever.
But a lot of that is driven not necessarily by higher quality of output of the work, but more around the economics of, we have this office space that we're committed to, and we need people in here using it.
That's not what you're hearing CEOs say, though. They're talking about collaboration.
Of course not. You can't carry the flag of, we're already paying for this shit, so you got to come in and use it. That's not marketable, but you can talk about culture and collaboration and all of the other things.
We're not going to solve this today, but I totally agree with the collaboration piece. I collaborate much better when people are in person. Much, much better. It's a thing. And Doug's looking at me like, and you haven't worked in an office in how long, Joe?
Well, I was thinking about the three of us who do not work or collaborate physically together more than a couple times a year.
Yeah, I get this huge spark when I go to industry conferences, when I went to Chicago to Strategic Coach. When I'm in the room with people collaborating, I find phenomenal stuff happens. So when they say it, whether it's window dressing or not. By the way, I was at the Cumulus Studios, the mothership of the corporate overlords who distribute our show. And oh my goodness, talk about empty, Doug. I mean, they did these, and they're stuck in a long-term lease, and their offices are probably made for, I'm going to say, the one floor I was on, I know they have two floors, probably, I'm going to say 300 or 400 people. And there were maybe 12 people in that entire office.
Yep.
And by the way, talk about morale killer is, if you've got an office that's made for 12 people and there's 12 people in there, you got an office made for 20 people or 12 people in there, there's a little bit of morale kill. I went in there and my morale went down.
Right. No different than going into a restaurant or a bar that's huge and there's
empty,
bunch of empty tables that you just don't want to be there
at 7 o'clock on a Friday.
How good could this place be? Yeah.
Yeah.
Anyway.
Horrible.
All right, great points. Thanks for sending that into us, Bob.
Yeah. Thanks to everybody. Doug, if you don't mind, I got just a couple quick ones that came from Spotify conversations.
All right.
Which have been really fun over there. On our Spending Too Much Money episode, which we got a lot of feedback on. Someone on TikTok, OG, looking at your ability to buy two Xboxes to solve the problem.
Was it well received?
They said something funny, and I said something funny back. We'll just leave it at that.
That OG, he's a man of the people.
El Husby says, when we were talking about the huge cost of airport food, taking off from Las Vegas to Charlotte, just paid $17 for a bacon, egg, and cheese and a cup of coffee from Rachel's Kitchen at Gate D. Preposterous, ... Airport food. Not that good and ugly. JD Dozer had a recommendation or had a request for next year. JD loved the best tax prep software episode that we did with the team from the College Investor, Eric Rosenberg, and said, as an early tax preparer, I'd love to hear this episode in February. Wanted to hear it sooner, loved the show. And we got it as soon as Robert told us it was out, JD. So I would love it sooner too. And in fact, I passed this on to Robert Farrington, who's the head of the College Investor, saying, please give it to us the second it's out. We'll see if we can get it to you in February, because I agree. Best tax prep software. We want that as early as you can possibly get it. And then last, on our episode about the surprising benefits of financial inaction, the same episode we talked about earlier, a nice comment from, it looks like somebody's phone number, Joe Duggan OG. If you're ever feeling burnout, let this comment be a reminder of the reason why you do it. I'm so thankful to be 50% of your fan base. Keep up the good work. Thank you so much to everybody for sending all this wonderfulness in.
I mean, why wouldn't you read that submitter's name out loud?
Well, it looks like it's their phone number.
That's my point.
8675309.
Oh, okay. All right. I'm going to call that person.
Is their phone number. All right. I think it's going to do it for today. Thanks for hanging out with us, everyone. As usual, love your feedback on our episodes. Also, big thanks to Barry. I've never had an interview where, as you heard today, Steve, our engineer, just had to slowly move into it because we just started talking. Literally, immediately, Barry and I just start chatting. I'm like, well, I guess we're in the interview now.
Guess we're going.
Never had that happen in almost 15 years. But Doug, something happens at the end of every episode. What should be on our to-do list today?
Well, Joe, first, take some advice from Barry Ritholtz. How not to invest is every bit as important as knowing how to invest. And you can learn lessons from many areas of life, not just your financial statements. Second, our stackers. Brilliant people coming up with even more ideas on job losses, working from home, and how Doug is awesome. All kinds of great stuff. But the big lesson? Don't tell Joe's mom you want to celebrate Bow Chicka Wow Wow Day unless you want a speech about, quote, wearing protection, unquote. Wait, you want me to wear gloves while I sing? I don't get it. Thanks to Barry Ritholtz for joining us today. You'll find his book, How Not to Invest, wherever finer books are sold. We'll also include links in our show notes at stackingbenjamins.com. This show is the property of SB Podcasts, LLC, copyright 2025, and is created by Joe Saul-Sehy. Joe gets help from a few of our neighborhood friends. You'll find out about our awesome team at stackingbenjamins.com, along with the show notes and how you can find us on YouTube and all the usual social media spots. Come say hello. Oh yeah, and before I go, not only should you not take advice from these nerds, don't take advice from people you don't know. This show is for entertainment purposes only. Before making any financial decisions, speak with a real financial advisor. I'm Joe's mom's neighbor, Doug, and we'll see you next time back here at the Stacking Benjamin Show.